Signal, not noise.
Is Nvidia expensive? Ask an investor, you will get 10 answers, and every one of them will sound confident. The bulls say it's cheap for what it's building. The bears say it's the most expensive large cap in history. Both sides have charts. Both sides sound reasonable. Not one of them can show you they're working. Here is the part nobody says out loud. Most people arguing about whether a stock is expensive have no method for deciding. They have a feeling. Then they go looking for numbers that agree with the feeling. A stock at $3,000 can be a bargain. A stock at $5 can be a ripoff. The price on the screen tells you nothing until you know what you are getting for it. So, this isn't a video about Nvidia. It's about the question underneath it. Stay with me and you will walk away with 5 questions you can ask about any company tonight. And by the end of the series, you will have used them to write a full verdict on a real one, out loud with me. Not a feeling, a method. Quickly, because the lawyer insists and because it's actually true, nothing here is financial advice. I'm not your advisor and I don't know your situation, your timeline, or what you can afford to lose. This is a way of thinking, not a recommendation. What you do with it is on you. Right, let's go. Discipline stock analysis. That word discipline is doing a lot of work. So let me define it. It doesn't mean complicated. No Bloomberg terminal, no finance degree, no cash flow model built in a spreadsheet at midnight. It means you ask the same question in the same order every time, including when you are excited about a company, especially then. The moment you skip a step is the moment you are back to guessing. There are 5 or 3 of these questions, and there is a 5th one that almost nobody asks. The few who do have a real edge. We will get to it. Before I show you the system, let me show you the 4 ways it goes wrong. These aren't stupid mistakes. They are the mistakes intelligent people make. I've made all 4, and one of them cost me real money. First one, you buy on price alone. $5 feels cheap. 500 feels very expensive. That's instinct. And isn't irrational. It's just wired in by every other purchase you have ever made. In the stock market, it's worthless. A share price is just the company value chopped into an arbitrary number of pieces. A company can split its stock tomorrow, halve the price, and nothing about the business has changed. Nothing. If the number on the screen is what makes something feel cheap to you, you are not analyzing. You are only shopping. Number 2, you buy on momentum. Up 40%, so it must be working. Down 40, so stay away. Those look like opposite strategies. Same mistakes in different clothes. You are letting the recent past tell you what to pay. A great year can leave a good stock expensive. A brutal year can leave a great business on sale. Momentum tells you what everyone else already decided. Nothing about what you are paying. Number 3, you use only one metric. The subtle one and the most expensive. You check the price to earnings. Looks reasonable. Done. Boom, you buy. Meanwhile, free cash flow is negative. The debt is due next year, and margins have shrunk for 6 straight quarters. One number was fine. The business was not. One metric is one window into a very large building. You looked in one window and decided you knew the whole house. Number 4, and this one sits under the other 3. You have no framework. Every decision starts from a blank page, no system, no consistency. And no consistency means nothing to learn from. You can't improve a process you never had. It's guessing with conviction. If one of those 4 just describe you, then it's good. That's the moment it starts to change. Here's the system that replaces all 4. Any company, any sector, any size, any country, every one of them reads across 5 dimensions. 5 questions. That's the whole framework. And really, they're the 5 questions your own written verdict on a company has to answer. The first one, the valuation. What are you paying? The price question, and where we spend the next few episodes to explain the price to earning, price to book, price to sales, and so on. 6 tools, same question, different angles. Number 2, the profitability. Is the business actually making money? Gross margin, operating margin, return on equity, and so on. Notice the question. Is it growing? The question is it earning? Number 3, financial health. Can it survive a bad year? Debt to equity, current ratio, and so on. Profitable companies go bankrupt more often than people think. And the warning is almost always here. Number 4, operations. Is it growing? And growing efficiently? Revenue growth, APS growth, free cash flow growth, and so on. 1 year is a photograph. This is the film. Number 5, shareholder value. Is management on your side? Remember the question I said almost nobody asks? This is the question. Buybacks, dividend dilution, insider ownership. Are they building your wealth or theirs? 5 questions. Write down your answer to all 5 and you have a thesis. That's the whole game. And it's what we build across this series, one question at a time. Most investors only ever ask question 1, and a lot don't get that far. The ones who ask all 5 are playing a different sport. Now, why each of these questions earns its place? Valuation. Valuation is the entry point. A business can be excellent and still be a terrible investment if you overpay. Excellence is not a price. Some of the worst returns in history came from buying genuinely great companies at genuinely great stupid price. Profitability. Revenue is vanity. Profit is sanity. Anyone can sell $1 for 90 cents and post a spectacular growth. The question is whether sales turn into money. Number 3, financial health. The section that saves you. A profitable business can still go bankrupt. And it usually happens the same way. The debt comes due, and the money isn't there. Profit is an option. Solvency is a fact. Number 4, operations. 1 year is a photograph. You want the film growing, shrinking, and standing still. At what cost? Grow both with borrow money isn't the same as growth that pays for itself. Shareholder value. The section retail investor rarely reach. Management can grow a company for years while quietly diluting you out of your share of it. Issuing stock to themselves, buying back shares at the worst possible prices, paying a dividend they can't afford. All of it public. Retail investor almost never look. I'll show you exactly where to look when we reach this section later in this series. So, how do you actually use it? First, it's not a checklist. Nobody scores a stock out of 100 and presses buy. It's a thinking system. The goal isn't to grade a company, it's to understand it well enough to have a real conviction-baked view on whether the price makes sense. Point 1. How to use it. The first point. Start with the valuation. What are you paying? Write it down. You won't know whether that price is reasonable until you understand the business. But knowing it sets the benchmark for everything that follows. The fundamentals, profitability, financial health, operations. The question changes from what does this cost to does this business deserve that price? 3. Look for divergence. When the metrics disagree with each other, that's the signal. Price to earnings says cheap. Price to free cash flow says expensive. Something is happening between reported earnings and actual cash in the bank. That gap is where the interesting questions live. Agreement is comfortable. Disagreement is information. Number 4. Compare to peers. No metric means anything on its own. Every time you see a number, ask 3 words. Compare to what? A price to earning of 30 is expensive for a water utility and remarkable for a software growing at 40%. Same number, opposite conclusion depending on the sector and the growth rate. And ask one more comparison. What does this return relative to doing nothing? In a 5% rate environment, an earning yield of 4% is not compelling, regardless of what the peers are doing. The risk-free rate is the floor every equity valuation sits above. Number 5. Form a view and write it down. Write the thesis. What you believe, why, and what would prove you wrong. The last part is the one everyone skips. Include one more thing. How much? Your conviction shouldn't show up in your position size. A thesis you would back with 3% of your portfolio is a different call from one you would back with 10. In 6 months, you won't remember why you bought it. You will invent a reason, and the reason you invent will always flatter you. Writing it down is how you find out if you are actually good at this, or just lucky in a bull market. This writing it down habit is the thing this whole channel is built on. You will watch me doing at the end of every episode on a real company. The framework won't tell you to buy or sell. The decision and the responsibility is yours. Takeaway. So, what do you have now? A system for reading any stock. 5 questions, 1 written thesis. And the last part is the one that compounds. Not any single metric you learn. The habit of writing down what you think before you act on it. Next, we start answering the first question. What are you paying? Big enough to take 3 short episodes. Earnings multiples first. Price to earning and PEG, then cash flow, and so on. And it opened a company priced at 30 times its earnings. Sounds insane, but at the end, you will know how to decide. In one line, whether that madness or a bargain, and you will write that line with me. One last thing. So we are precise, because this is where most people get it wrong. This tool won't tell you what to buy. They'll tell you whether the price is reasonable. That's a different thing, and a far more useful one. If you want to watch these theses actually play out, company by company, quarter by quarter, this is the series to follow.
No guessing. Your call.